been wonderful to follow the conversations this morning as we slowly narrow down and talk about the really key issues. We've heard about this $100 to $200 billion a year of infrastructure financing gap. We've heard about our very well documented challenges on the continent, poor bankability of projects, a lack of capacity in government and sovereign agencies. We've also heard about the fact that we've got the most youthful population on the continent, a continent rich in minerals and resources, a continent with infinite renewable energy supply. One of the things that we wanted to narrow down the conversation to today, specifically around infrastructure, is to talk about logistics and railway infrastructure. Won't you join me in welcoming my guests this morning? Panelists will help us talk through some of the issues that face us for railway infrastructure, talk through and explore how we unlock funding, and talk through and explore some of the key shifts that are required for us to really move the dial forward. Please join me in welcoming my guests. I'll introduce them shortly. Mr. Raphael Owino, James Holly, Tristan, and Constantine. Thank you. Gentlemen, thank you very much. I wanted to specifically narrow the conversation to the rail discussion. I think one could argue that investment into Africa's railway infrastructure will most certainly drive economic growth by bringing down the cost of cargo. It'll offer efficient exit routes for critical mineral sectors. It'll significantly decarbonize by seeing a lot more trucks off the road. As we know, currently 80% of our cargo is still transported via the road network. And scaling transportation will certainly see more intra-African trade. And so let's explore some of the shifts needed, the roles of the different stakeholders, the opportunity before us, and some perspectives on some of the unlocks required. Raphael, if I could start with you, I think in an instance where this is infrastructure that spans geographical regions, spans across countries, most often owned by governments, what role should government be playing in really creating an enabling environment to accelerate rail sector investment and development?
Thank you very much. I was very glad to hear the Deputy Minister mention in the last panel that the government doesn't have to finance infrastructure. I wish that would happen everywhere, but that is really, really far from the truth. But of course, the government has a much bigger role than just financing infrastructure. The government has a role in formulating the policy that guides the development of infrastructure, that guides the development to link it to the overall priorities of the country, so that as the private sector players are developing infrastructure, then that has to link to the overall priority and development goals of the country. Of course, the government also has a role in mobilizing key players that would come to invest in infrastructure. For example, if you want to do a PPP, you need to get the key players in the PPP field to come and be involved, but also mobilizing other interested parties. For example, in East Africa, in coming down straight to the rail network, we are currently developing a regional rail network, and here the government is playing a key role of making sure that whatever Kenya is doing is feeding into what Uganda is doing and is feeding into what Rwanda is doing, such that the rail line that we are currently developing from Mombasa to the border with Uganda is going to link seamlessly with a rail line that is being developed by Uganda to the border with Rwanda, and then Rwanda takes it on to the border with Kigali. So bringing up that regional connectivity and agreeing on what are the standards that is required for the new railway line that we are doing, what is it that we need to make sure everything aligns to each other. So the government, yes, has a very big role. But even in terms of mobilizing infrastructure, the government still has a role to support. The rail line that I'm talking of, the Kenyan one, the standard gauge railway, the first phase of development, what we did was largely finance that from borrowed resources, largely from China. And that was very, very expensive. So what are we doing going forward? Going forward, we have adopted a strategy where we are going to mix public financing with private infrastructure so that we bring in private players who will then run the rail line for some time before then handing over to the government after getting their returns on their investment. So we are changing the model because of the experience we have had into a model where the private sector plays a bigger role, not only in running the infrastructure, but also contributing financing to the same. Thank you.
Thank you. Thanks, Raphael. I mean, it is also a sector that requires arguably one of the largest deployment of capital. And so, simply relying on traditional PPP type frameworks and structures would not necessarily solve the problem. How do you see the need for concessional financing, grants, and even blended finance as a solution to really unlock railway infrastructure?
Thank you. Now, the concessional financing players don't seem to look at railway lines as a darling of investment. They more of finance, what I've seen is finance projects such as water and sanitation, direct budget support to the government. But when you want to do core infrastructure such as railway lines, I've not seen a lot of concessional financing going into that. But blended financing has been there supporting these kind of projects. And of course, if you go to commercial financing or semi-concessional, I think that has been available for railway financing and other infrastructure development financing. And I think this is where the international players, the multilateral institutions need to rethink. African Development Bank in Africa has done a great deal in offering concessional financing for road network, but I've not seen a lot of attention to the railway network, which is where now we should go.
Thank you. James, if I can move over to you. I think we've got a few or a number of success stories to tell on the continent, but the private sector could be described as being frustrated by the lack of momentum or the lack of progress. Would this be a fair comment?
I think the answer to that is yes and no. I think, if we use South Africa as an example, where we're going through a really transformational rail reform, no, in that I think in a relatively short period of time, you've had to write a reform strategy and implement a reform strategy for a country that has had a monopoly that's existed for a century. And is one of the biggest rail entities in the world. And that's no mean feat. In the context of collapsing cash flows, over-indebtedness, infrastructure problems, it's a challenging task. And I think where we are today is you've got a strategy for both rail trains, above rail, and infrastructure that makes sense. And you've got a national rail policy that's aligned with subsequent policies that have been released. You've got an economic regulator in place for the first time, and so great progress in that sense. We are frustrated in a sense that we had the release of the network statement in December, and we're just not quite at the point of that being investable yet. And at the end of the day, if you can implement any reforms you want, but if it's not investable, then the battle's not won. I'm extremely confident that we're going to get to a point of investability. Okay, that it's and you can't sort of underestimate the challenge of the journey that South Africa's had to undertake. But we're very close. I do think if you look outside the borders of South Africa. The company that I run is a private rail operator. 7 years ago, we operated private networks in South Africa, and we operated in Mozambique. Today, we operate in 9 countries, and that's because of the implementation of regional rail reform, which allows private operators to access the national network. So significant progress has been made. I mean, it's undeniable.
I mean, what struck me as you were speaking is certainly, I think you're right. I think it is something to be optimistic about, particularly around the period of time over which we've seen significant momentum, specifically in South Africa. And I think, when you talk about large-scale reform and you talk about really being able to shift it, what has contributed to it in SA specifically is what you would call a real partnership of all stakeholders. So operators, infrastructure owners, owners of capital, freight owners. I mean, for each of these stakeholders, to kind of drive interest to get to a point that gets us to projects that are bankable is certainly, I think, a recipe for other markets to consider. I want to touch specifically on the owners of freight. I mean, arguably, these could be the biggest key to unlocking a structure that is bankable. Some perspectives on that?
Yeah, Adil, I completely, of course, agree with you. In our world, everything starts with the freight. Okay, you can have the best railway line on earth if you've got no freight. It's of no relevance to train operating companies. Okay. You have to look at the freight opportunity that South Africa presents. You've got, Transnet in 2018 moved 226 million tons. Their current annualized run rate is an improvement from 149 million tons to 160 million tons over the last 3 years. But you still significantly below at 66 million tons below where they were. It's generally accepted that the demand for rail freight in South Africa is about 250 million tons. So that's about 90 million ton shortfall, freight shortfall, as to what's going on, what should be going on rail. And it's important to remember that not all of that goes on road. In fact, a lot of it is a complete economic opportunity forgone. So in the context of that freight opportunity, there's a significant rail opportunity. And to put it into numbers, 90 million tons of freight requires more or less 75 billion rand of trains. Okay. And then, when you say, well, in order to get 75 billion rand of trains running, how much do we need the infrastructure to be uplifted to get to a condition where those trains are really operating efficiently? And that's more or less about 200 billion that I believe the South African freight network needs in order to get it up to condition. So you're looking at a number of about more or less 300 billion rand that's needed to get the South African rail freight industry into a condition where it's really moving. Your question is, what role do the freight owners play? Well, I mean, they play a fundamental role in getting that unlocked, okay? Because when we make an investment decision to buy one of Tristan on my left's wonderful 23E locomotives that he manufactures in Durban, we make a decision to invest in an asset that on the spec sheet says life of asset 30 years, Okay? So unfortunately, when you're making an investment decision of that period, you have to be pretty certain about that investment. It's a very high capital cost item. So in order to really make that make sense in the environment of high road competitiveness, you need to be able to leverage equity returns. You need high levels of debt. To get high levels of debt, what do you need? You need the ability to generate income from your asset for a long period of time, long-dated access rates, but then you need long-dated commitments from your customers, from the freight owners, and that's the other side of the coin. So when we come to our lenders, which of course may or may not include Standard Bank, we go with two very important agreements: rail access agreement, which is the one that I think needs some work, freight services agreement with our customer, and the strength of that customer ultimately underpins the cash flows that underpin everything.
We touched on, just volumes of freight, and we touched on the on-the-ground infrastructure. Tristan, if I may, it'll be a good time to kind of talk about, we want to add more and more freight. We know we've got significant shortages of rolling stock on existing infrastructure. It would be interesting to get some perspectives on the role that technology plays in accelerating rail reform.
Absolutely, thanks. So first, before the how, just a little bit more on the why, and you've touched on many of them, but the way I see it is that on the African continent, traffic congestion is going to cost about $500 billion of GDP by 2030. So in just half a decade, you're just talking gigantic sums of money that are just being lost due to poor infrastructure and not enough rail. So a little bit on the how. One of the key pillars is signaling. If you're able to improve signaling in rail, and that's freight and passenger rail, you unlock just a lot better cycle time. If I look at freight, the cycle time between the mine to the offloading point and then back to the mine, you reduce that and you just get massively more revenue. And it's the same for passengers. Currently, there are very good trains in South Africa, the Blue Train, but some of them run at 60 minutes. So if you miss it, you have to wait 59 minutes for the next one. And there are pretty simple ways and implementable ways of reducing those headways. And I think in South Africa specifically, it would be about using the onboard equipment that's already in the locomotives and the trains, using the GSM radio signals, which already equip a large part of the networks, both for PRASA and Transnet, and really minimizing everything that's wayside equipment. So that's going to be your equipment along the track, because obviously those get stolen, they get vandalized, or you cover such huge distances in the case of freight that it's just very hard to maintain security over everything. But there are ways to capture these, so that's the first piece on signaling. Another piece of innovation or technological improvement lies with many things hybrid, okay? On these vehicles, on these trains, these locomotives, it's not very difficult to equip with a diesel power pack if you're running an electric product, so that if there's a section of the line that's unelectrified for whatever reason, then you can still bridge over to the other side with a diesel solution and then regain some electricity and keep running your operations. You're not stuck for hours and days. There are many other hybrid solutions. There are batteries that can be installed, same if you lose a catenary signal, et cetera, et cetera. We can also install diesel for last mile in a locomotive application. I think the last one is optimizing all of that. So optimizing your operations, and it's a similar industry as to many other industries and people in this room. We are looking at predictive analytics. We are looking at better route management. We're looking at reducing the time for operations, and all these in turn will boost.
I think it's not often, that you talk about sustainability and energy transition in the context of rail and rail infrastructure. I do think, though, that the thought of using rail and improving rail infrastructure as a decarbonization tool for that congestion you speak about on the roads is a really strong factor in mobilizing capital. Is that, some of the rhetoric that you've been seeing in your industry?
Yeah, absolutely. And frankly, we've been seeing it across all continents, but specifically for Africa. Maybe a few numbers to frame what we've been hearing and what we've been saying. Rail is, it emits about 5 to 10 less greenhouse gases than car or plane, and not directly linked, but linked to sustainability, it's also 100 times safer than driving a car, okay? So you have a natural argument. It's almost a green, natively green industry when you talk about rail. And we've been having these conversations. It's also rail, you think about urban centers, extremely congested. There are 50 cities in Africa with more than 1 million inhabitants. And so any piece of urban land is going to get more and more scarce. So you just think of the space that it takes, and installing a heavy rail system on a width of about 3.5 meters, so that's about the width of a road, you carry 40 times more passengers. So you're just in a completely different game in terms of capacity and moving people around. And of course, those same people that get from their home to their work, to their schools, to health centers, to hospitals, they do so at a fraction of their disposable income. Specifically in this country, there are people who spend 40, 50%, 50 plus of their disposable income on transportation. So when you offer, when governments offer solutions which are a fraction of that, it frees up more income for the rest. So yes.
Thanks, Tristan. Constantine, if we can pivot the discussion a little bit now towards capital and accessing capital. Not often an asset class that garners the amount of interest we'd like from capital providers. How would you describe market appetite for rail infrastructure on the continent?
Thank you for that question. Listen, the rail sector is, you've gone through the stakeholders. Your owner of the infrastructure is the government, and all the other players are largely private. The operators, the rolling stock providers, and the owners of the freight, often. And the structures that have been used over the past years have been ones where you are involving private sector in the development of rail through PPPs, concessions, but ultimately, due to the lack of tariffs and other things, the burden of the financing, attracting that debt, has been put on the government. Wonderful model, it works well. We've seen it in Tanzania, we've seen it in many other countries. However, for a debt provider, your credit risk is on a host government, right? And they will, of course, want to borrow the money at mid to long term to match the investment, and therefore they are looking to raise 7 to 10 or 15-year money. And if you look at the last 5 years on the continent, they have been one of a very pressured operating environment, downgrades of the sovereigns, pressures on these, right, FX shortages. So the credit risk that you are taking on a government is high. And this sector is a marriage between the private and the public sector. The other thing is, by making the governments the obligors, which is the right model at the moment, it is considered by many development finance institutions to be a public sector project and not a private sector project, right? So there, your names like an IFC or a DG Proparco are immediately precluded from doing that. Now, What I think, and so how do I get away from this, right? And I think we've heard it on this panel a few times, and we've heard it on some of the others, the previous panels. What is changing at the moment, I think, is the commercial industrial play on the whole continent. With the operationalization of the Continental Free Trade Area, we're going to see changes in investment decisions. We're going to see changes in the direction of trade and those corridors. And we at Afrexim Bank are already working at supporting and driving the creation of industrial parks, free trade zones, manufacturing, everything that is linked to export development and value creation. And I think that once you have that, trains don't stop somewhere just because they want to stop there. They stop there because people want to use them, right? And it's not just about driving your chickens to the market. If there's a massive industrial zone there, you're going to build your rail line there. And and you've done plenty of project finance in your life. Normally, it is the developers of the plants that come first. And then one says, okay, you government, I need you to help with the rail line or with water or other supporting infrastructure. But that supporting infrastructure always follows that initial value creation or manufacturing concept, right? So I think with this game changer that is coming and the industrial commercial play that I think we're seeing more of, and that needs to be then worked out how you bring that in, I think that is going to definitely change the market appetite that you have already by giving it a more commercial dynamic. Maybe I can just stop there.
Yeah, I mean, I think, the one thing that that always comes up as a key challenge is, one, these are significant quantums of capital required for this type of infrastructure. Your sovereign obligors are often at their own limits in terms of ability to take on more liabilities on their balance sheets. Sovereign agencies that are in charge of rail have similar issues. And so as providers of capital in the market, the type of partnerships we need to start developing with MDBs and often with global export credit agencies start becoming more and more critical. In your experience, are you seeing these agencies have more appetite for this type of infrastructure, have more innovative ideas around credit-enhanced structures that can help us unlock more capital for railway infrastructure?
Absolutely. As I said before, of your 4 stakeholders, 3 of them are largely private, and a lot of them are ex-African as well. So if you are exporting goods and services from France or from China or the US or anywhere, your export credit agency is going to be key because they are there to facilitate the export of goods and services from that country that is exporting into Africa and into these specific projects. And that is, you can have that for rail and you can have that for rolling stock. The ECA is a key. And I think we are seeing more innovative structures there. Right, the ECAs can do the typical cover for the exportation of goods. We, as development finance institutions, are also using the ECAs through on-lending structures. So not standard bank, let's use a different example. A Japanese bank will lend money to Afrexim Bank or to TDB or DBSA under Japanese ECA cover. That gives us access to cheaper funds and longer dated funds, and we will then on-lend those into in this case, a rail project. If you look at, for example, the Tanzania rail project, you had a lot of the African development finance institutions lending into that, but we all received on-lending lines from development finance institutions and MDBs to bring down the cost and our ability to lend longer-dated money into that project, right? I think one of the issues I'm seeing, though, is that some of these ECAs, their limits on these countries are filling up, right? So there are ECAs who will say, I'm sorry, I can't do any more Angola, I can't do any more Nigeria. And then that drives you to on-lending structures, right? But that means that Afrexim Bank, or the other DFIs are carrying more risk, right? And that needs to be spread a little bit more, right? And so I think that is one of the things that needs to be unlocked a little bit. And then obviously there are plenty of guarantee providers. There are the whole insurance market that you've invited today also play a critical role in de-risking. Right? There's two elements. One is bringing down the cost of funds, and the other one is the de-risking element. The one thing I must say is we're very smart at doing this now. We all know each other. To have the insurers in the room, the ECAs in the room, the DFIs, the commercial banks, we've all got each other in our phones. We've done the financing structures before. It's so the ease. There's an ease of bringing these pools of capital together, right? But at the end of the day, most capital is following some kind of economic interest.
Yeah.
The Chinese banks don't finance a rail project in Africa unless it has Chinese content, right? And it's the same for the French or whatever. So, and I think that works. And I think it just needs to be rolled out more, enhanced more, and it will. And I think the partnerships are there.
Yeah. I mean, coming back to the partnership point, Raphael, if you could swing back to, I suppose, ministries of finance, government, owners of infrastructure, we're hearing that there isn't necessarily a shortage of capital. There isn't necessarily a shortage of tools to unlock capital. What would you think are the key impediments that are currently not giving us the momentum we need from a policy perspective?
I think one key impediment is the perception that the investors have in terms of the risk. I think the investors seem to have placed too much a premium on the risk in investment in some of these projects. And I think they need to be looked at differently, because that perception of risk is making the cost of investing in these projects very high in terms of financing costs. So if we could have projects looked at in terms of individual risk that they pose. A railway line, for example, I think it's an piece of infrastructure that any investor would be sure of getting their return back. And therefore, the risk associated with this type of investment is much, much lower. And this is where I think financiers should relook at and provide financing at a reasonable cost compared to investing in other types of risky infrastructure.
Thank you for that. I mean, James, maybe some parting shots, right? I mean, we arrived here this morning to some, I think, fairly positive news in SA. We've obviously been closely involved with the reform story. Requests for interest have come out this morning. As a private sector player, and Tristan, for you as well, that type of news, what does it start signaling?
It's hard to sort of exaggerate what a game-changing moment it would be if the South African government is successful in implementing those 3 projects. It really is, you're talking about each of those corridors would be a logistics business on its own that's bigger than the biggest private logistics businesses that are listed on the Johannesburg Stock Exchange at the moment. And it's not really, we keep on trying to remind ourselves in the rail industry that we actually are not industry. We serve industry. We are a network that serves an upstream economy. And in South Africa, you've got an upstream economy. We've got 1 in 3 people out of employment. And that's the problem you've got to solve. You've got to solve for how do you create a network industry in South Africa out of the railways that is competitive enough to stimulate an upstream economy to create significant growth, okay? And the reason why, as Traction, we have been optimistic about South Africa's rail prospects for some time since government signaled what they were going to do, and they're doing it, which is very important, is that the freight exists. It comes back to your first question, Adil. The freight exists. When you look at the iron ore line and the manganese, the iron ore line from Sishen till Saldanha, and manganese down to Kuche PE, the freight volumes that exist for standalone financial feasibility, okay? When you look at the northern corridor, which brilliantly has been extended not just from Ermelo or from the mines around Ermelo, it's been extended into Limpopo, so you've got a complete system. The freight volumes exist, we believe, for standalone financial feasibility. Now, the power that represents for an economy is huge because you don't have to constrain the fiscus by giving underpins to get those projects away, and the economic uplifts upstream are significant. The third project there is the intermodal project, which is very widely scoped, okay? Parts of that I don't think are standalone financially feasible. But if you can get, back to concessional funding, if you can get a World Bank hook, and I know that comes with government guarantees, if you can get a World Bank hook onto those projects, it changes the game, and those projects become unlocked. All of a sudden, okay, all of a sudden, you've got a scenario where South Africa's logistics is globally competitive. And what does that mean for our economy? I think it's significant.
Yeah. Yeah, I mean, I think the one thing that comes through over and over again, and we can talk about, you know, capital pools and policy reform, but the kind of baseline theme across infrastructure development, whether we're talking about roads or rail or free trade zones or manufacturing, is this multiplier that comes with it for economies. And I think that's really you know, what we're after on the continent. Thank you for this insightful discussion. Ladies and gentlemen, my panel, Constantine von Molk, AfriExim Head of Syndications and Risk Distribution, James Holley, CEO Traction, Mr. Tristan Lamar, Alstom MD Southern Africa, and Rafael Otieno, Director General Debt Management Office in Kenya. Thank you so much. Appreciate your time, gentlemen.